a finance manager, and I think I did a number of few things there. In the real estate sector, agriculture, education, I did a lot of projects in financial modeling, and then I later moved to join KPMG. So I joined KPMG in 2021, and when I left KPMG somewhere February, I set a great place to work. And so I was with KPMG for about 3 years, 11 months, and I left as as a manager, and recently joined EY as senior manager. And so I have been leading a number of engagements in valuation and due diligence, transactions related stuff, corporate finance, and all that. I've done quite a number of work in that space. And then I held a number of training sessions at KPMG, of course, for KPMG Ghana and KPMG Nigeria, a lead trainer there, and also joining EY now. I think ever since I've been looking at how I can contribute to the development of finance in the country. And, and what I mean by that is contribute my expertise and other ways to doing things. Great. Please, in case you start losing me, please just put something in the chat for me to see. Sometimes when you do these kind of stuff online, because you're not seeing people, there are some difficulties there. Let's get straight to what we're going to be doing. And we'll be spending 2.5 hours. Today is already started, so by 7:30 we should be done. And for the next few days, that's what we've been doing. So we will be spending 2.5 hours each day, for I think 11 days in total when you sum them up. It's a lot of work we're going to be doing. Valuation is kind of more than science, but in this day and age we find ourselves in, the science and art are coming together. And so there's a science aspect and there's also an art aspect, and we're going to be working through all that. What I want to do quickly is to walk you through the program outline that we'll be covering over the next few days. I hope you can see my slide. You can see my document shared. Can you see, please? Can you see? Can you see my? Yes. Okay. Great. Now, I hope to have a great time with you. So we are going to be covering 4 major items. You look at an understanding of the advanced commercial bank. What do they do, right? So look at the business and economics of banking. And then we look at financial statement modeling for banks. Of course, we need to do some financial modeling. And it's an area that a lot of people don't really have the grasp over. But we're going to be going through this nicely, right? Equity valuation modeling. So from the financial statement modeling, we get into equity valuation modeling. And there are a number of stuff that we'll be looking at there. We're talking about capital market expectation. And so that will help us to come up with risk premium. And then based on that, we come out at discount rates. And then we look at some valuation models. And then we will be looking at the valuation results, the output from the models that we're using. And so we will look at that and evaluate that against companies listed on the market to see whether there is some relative opportunities in terms of whether the stocks on the market are overpriced or underpriced, and how we do. And then we'll tell stories about the reality on the ground, right? That the market may not be that efficient to actually absorb some of this information. We will discuss that. We'll talk about some advanced analysis in terms of how we can do some simulations around our valuation outputs, how we can perform some simulation. And here we'll be doing statistical simulation rather than the simple or the simpler ones in Excel. We'll be bringing in some advanced models to look at that. But of course, my objective is to break this down as much as possible for you to see. When necessary, I may bring in a VBA code, but that will be for the simulation part when necessary, and you may not even need it, right? We'll talk a bit on the Ghana Stock Exchange market. We'll discuss that into details, look at the data out there for the various banks listed on the stock market, right? Dara will be a very common ground for us to play in, and the number of data there that we can actually chance on in terms of research already done. We need not to spend much time doing the research again, but we're going to be understanding the economics of all this before we look at that. Yahoo Finance, when necessary, we're going to get some data from Yahoo Finance, and Bank of Ghana definitely, as the regulator of the market, we're likely to get that. Great. So we're going to be covering, I think, a maximum of 5 modules or so. The first module focused on the business and economics of banking. So quickly, I want to walk you through the scope of the program. And before we start the first lesson for today, and well, how I'm going to approach these may not be the traditional class where you're going to be learning a lot of theories and all that. I'm actually channeling everything towards evaluation. At the end of the day, what are we trying to estimate? And whether the things we are learning are relevant or not. I want it to be relevant to it. So I'll introduce you to the banking business and how that affects valuation, or how that affects the way we value the business. Then we talk about some economics, right? Economics banking, we talk about macroeconomics and how that affects the banking business and variables or the factors. Well, whichever we see is going to affect the fundamental drivers of value of any business. So affect fundamental drivers of value of any business. And we also look at some financial reporting basics in terms of how banks' books are run, not to get into the very details of financial reporting, but here, what I intend to cover is how loans are created and the adjustment are passed, interest income calculated. See all those items on the bank's financial statement. We need to understand accounting, the basic accounting principle behind that. That will be very important because if we don't understand this, it will be difficult for us to model the balance sheet and P&L more well, and by essentially the cash flow statement. There are a number of people, or there are people who do bank modeling who don't really understand the accounting principles. And because they fail to understand accounting principles, they don't do it quite well. And so we're going to get into that. Now, but before we get into the meat of the program, I would just want to say that the modeling we are coming to do is for valuation purposes. And so some details, some very fine details may be missing, but as much as possible, I'm going to ensure that I'm doing the best of work as far as valuation is concerned, right? Now, so the second module is quite extensive. That's going to be on the financial statement modeling for banks. So we talk about analysis of historical financial statement, and that's where we look at some few things like historical trading analysis and all that. We will come up with a model framework architecture that we need to design. We need to design a model framework architecture. We're going to look at that, and then we will go ahead to look at a model output analysis and how to analyze the output from the financial model, right? Then we look at formulation of capital market expectation as the third module. This side is going to be a bit technical, but we'll look at the CAPM, we'll look at all those stuff, how to estimate risk-free rates, how to estimate the various risk premium on the markets. And I'll take you through the sciences of these as well, and also the art and what we do in practice. Then we will get into the equity modeling itself, look at the alternative methods we use for equity modeling, and by extension, equity research work, right? Then investment decision based on the output. Of course, we need to evaluate the valuation results. So we do some simulation, we do some hypothesis testing and all that basic stuff, and how we also set target prices and identify mispricing. And also we look at a research report or evaluation report. So that's how it's going to be. Great. So that is it for that side. Will the resources be shared later? Yes, the resources will be shared later. Great. So I'm going to start right away with the lecture for today. Any question from anyone apart from the one I've seen from Felix? Any question from anyone else? Okay. All right. Can you all see my new slide now? First model. Is it visible? I hope you can all see, right? I see two questions. I don't know whether questions. Yes, yes, yes. All right, great. So let's talk about the first model, business economics of banking. And so it's now 5:26 here, and we have about 2 hours to cover this. As much as possible, by popular request, I'm going to take my time and to ensure you grab the details of everything we're coming to do today. I'm not going to rush it at all. If you have any question, you can just drop it in the chat and then our turn. So someone is asking, please, I'm from economics background. I hope you will take time to explain accounting principles. Oh, definitely, Anthony, I'll do that. I'll take my time to explain that. Good, I'll take my time to explain that. When you do valuation, there are some few things you need to understand. You need to understand a business really well. You need to understand what you're valuing. Definitely, because you can't value something that is hidden from your sight. You have to see what you are valuing. You need to examine it. Okay. So if you want to buy anything, you go to market to buy anything at all. What you do first is that you examine it. You go to a traditional market and even any other market at all. You examine it, you read about it, see whether that is what you really want. So the price you're going to put on the item at the end of the day will be dependent on what you think the value is. But in most cases, not just what you think, but what the market thinks the value is. Sometimes you can sit down to estimate any value at all. You can sit down to estimate that, well, based on this, I think this should be priced like this, like that. Anyone at all can also do their own analysis and come up with what the value they think should be. But the final value is a matter of demand and supply on the market. And that's what happened on the stock market. It's a matter of demand and supply. So when we say we are doing a business valuation, we want to understand a business and use that as basis to estimate what we think should be a fair price. That doesn't mean that that price you'll be coming up with will be exactly what is on the market there. Now, and also it doesn't mean that the price on the market is the accurate one. The price on the market may not be the accurate price. And that is the reason why we're doing evaluation to start with, right? Now, so this module, I'm going to cover it over a 2-day period, today and tomorrow. I'll cover the business and economics of banking. Great. And let's just get into it. So the lesson 1, we're going to be talking about overview of business of banking. And that's what we're going to be doing today. Now, the first item I want to start with is bank valuation, why the business model is your blueprint. We need to make the argument why we're talking about business model, or sorry, why we're talking about the business to even start with. And the first thing you need to understand in any valuation you do, or maybe in the valuation of a bank, is understanding of the business model. That's extremely key. You need to understand how banks make money or how banks are run. What is the nature of the bank's business or the banking business? You need to understand that to start with before you even talk about how to put a value on a bank. Because if you don't understand how banks make money, if you don't understand what is valued by investors when they're investing in a bank, if you don't understand how banks are run, you won't be able, or you will find it difficult in putting an appropriate value on a bank, or even what drives value from the perspective of the investor. So if an investor is looking at a bank, what is the investor thinking about? What is that the investor values as far as a bank is concerned, right? And that is going to impact how you put value on the bank. Now, my first slide here, I want to talk about what the equity analysts actually care about when they talk about banks. Now, so the statement here, what I'm going to be doing in this few slides that I'm going to be speaking to this evening, I'm going to be reading partly, and also I'm going to be explaining to you. I'll be giving you insights. And so if you have a question or any contribution to make, you just put in the chat, and then I'll read it out to those that are participating of Zoom, right? Now, so the whole idea here is that you can value banks like companies. I mean, industry or the industrial companies. You can value banks the same way. So their business model actually dictates their multiples or their basis for the valuation, right? Now, that's actually an error there. I was trying to say it dictates their basis for valuation. Now, if you compare a banking business to a traditional business, you can actually see the differences. For traditional business, especially those involved in manufacturing, they manufacture products. Of course, the banks don't do this; they do something else, right? Now, so the balance sheet of a bank is actually similar, or it reflects the business model of the bank. So on a balance sheet, you tend to see the bank's assets, and the bank's assets are dominated by the loans. Of course, we can make an argument or make argument around investment securities, but the traditional purpose or for the establishment of a bank is actually to mobilize deposit and create active, or that's the main assignment. So a bank's primary assets is the loan. So the loans represent the asset, of course. Investment securities are there as well, as I mentioned. And the liabilities on the bank's balance sheet mainly has to do with the deposits. Now, so these are actually the core operations of the bank. So when you talk about traditional businesses, you will be talking about factories and inventories and all that, right? So they have factories, they have inventories, and those will consider them to be the asset. And if you look on the same balance sheet, you're going to be seeing the liability aspect, like the loans, the borrowings they've done, or maybe a bond they floated or something, right? On a bank's balance sheet, you are likely to see the same debt items like bonds and all that. But the whole idea here is that a core operation of a bank is deposit mobilization and creation of assets. And if you could see, to see that banks' major business has to do with, look, go ahead and mobilize deposits, which is kind of like mobilizing liabilities. It's a liability because it's an obligation owed to it's an obligation that the bank is obliged to honor to those who place the money with the bank. So people place money with the bank, and then the bank doesn't have ownership rights over those monies. In other words, the bank has borrowed the money from the public. But the difference between the deposit and the traditional loans, debt or liabilities on the balance sheet of a traditional company, if I mean traditional company, I mean non-banking firms like manufacturing firms and all that. The difference here is that with the deposit, the customer can come for the money anytime at all. And some of these deposits don't have a lifespan. If I say they are not termed, in other words, they don't have a maturity period. Okay, well, of course, if you have a current account, we won't say that, well, I'm going to put my money in the current account and the bank is going to hold it for 50 years or 5 years or 3 years or whatever. You can withdraw the money at any time at all. But there are some other deposit accounts that are term, so we can have, and oftentimes we call them term deposits, or sometimes you call it fixed deposits and all kind of names, right? So if you have a fixed deposit account, of course, you can withdraw. With some banks, you can withdraw early, but that comes at a cost, right? So that's the nature of the bank. So the bank's business, so the business model is reflected by the balance sheet, clearly. Now, another aspect of a bank's business is the regulatory capital rule. Now, banks need to have some capital set aside, so in case there's problem. And whenever we talk about the word capital, of course, the meaning of capital it depends on who you're speaking to. If you're speaking to someone in normal business, he's talking about, some people tell capital is the amount of money used to start a business. Of course, that's what people used to say, but maybe a proper thing could be capital is the amount or the value of resources used to run an enterprise. That is also true. That also makes sense generally. But when we come to a bank and we talk about capital, it goes beyond just to say the amount of financial resources used to run an enterprise or run the bank. That is true in general terms. But when we really talk about capital here, we mean that value of or that money or financial resources, or whichever we want to call it, that is set aside to absorb losses. Okay, so to absorb losses, so in case, so that the bank doesn't fail. Okay, so it absorbs the losses, the potential losses the bank could incur. And the capital is determined by the regulator. The regulator determines what should be the minimum capital you should have before you start a big banking business. And there's a metric that is used to track this to see whether your capital is adequate or not. Now, so when we talk about capital too, it's not about the amount that really matter, even though there is a minimum amount you need to have, not necessarily that amount that matters here. What matters is that metric. We're not talking really about absolute numbers here. We are dealing with relative numbers. For example, if we say, well, the minimum capital for the bank, for banks in Ghana is 400 million. Does that mean if you have just 400 million, you are cool to go? Or if your total equity is 400 million, you are cool to go? No, not really. Okay, so we can have a bank that is running a very risky business, and based on the risks it's taking on to this balance sheet, it needs a higher level of capital. You see, so you need a higher level of capital. Even though regulator says the minimum is 400, it doesn't mean you should always keep the minimum. So there's a metric that tracks that, which we call the capital adequacy ratio. We're going to talk about a lot of times in this lecture series, right? Now, so the capital here actually determines the solvency and regulatory compliance of a bank. So if you fail this, the bank collapses, and that all happens. So if we say the bank, you have failed this, it means the capital is not sufficient to absorb potential losses from the business. That's the whole idea, or from the bank. The regulator sets the minimum capital adequacy ratio. And so check the word. The word is capital adequacy. So in other words, whether the capital you have here is adequate or not. So it's a matter of something relative to the risks you are taking at the end of the day. Good. Now, if you check this concept of capital as well, again, if you look at the balance sheet in general terms, you tend to have assets, then you tend to have liabilities and equity. In fact, when you take the asset if you take the liabilities out of asset, then you left with equity. So if you have higher capital, it means that your liability is shrinking. In other words, your assets are able to cover your liabilities, sufficiently, and that the bank doesn't run into problem. The whole idea with the bank not running into problem is if depositors all come to the bank and say, we need our money. If depositors start chasing the bank for their money, will the bank have enough liquidity to pay those monies out? You see the whole idea here. Will the bank be capable, not necessarily liquidity now, but again, if the bank is dissolved, can we settle those depositors? Right? As to whether we will be able to meet depositors' demand, maybe on a weekly basis or something, there are metrics that track those liquidity concerns, right? But here we're talking about solvency, more of long-term sustainability of the bank. Another issue with the banks is the issue of volatile earnings. So you see, bank earnings are quite volatile. So if you take the P&L of the bank, the sources of revenue to a bank are the revenue coming from its assets. And when I use the term asset of a bank, I'm not trying to mean property, plant, and equipment. No. And I'm also not trying to mean fixed assets, of course, which is the same as the property, plant, and equipment, which way you see it. So the word asset, as we see it in the traditional businesses, I'm not trying to mean that, even though it's also an asset of the bank, but each time I use the word asset, I mean the interest-bearing asset, or the assets that the bank is milking in terms of to get revenue. Those are its loans and advances granted out to customers, and also investment securities. So when I talk about assets, I mean those two things. The investment is made in government and corporate securities. So, of course, government securities, you tend to have the bonds, you tend to have the treasury bill. So treasury bonds, you have treasury bills, you also have the treasury notes. And tomorrow we're going to talk about economics of banking, and we will speak a lot about those ones. And banks may also invest in corporate bonds or corporate securities as well. in addition to that government. So we can put all that together and call all of them investment securities, right? Now, so as I mentioned earlier, when I talk about assets, I mean the earning assets or the interest-bearing assets, which is made up of the loans and investment securities. So I mean earning assets, earnings. So in other words, so earnings, that's EARNING, earnings. The assets that are earning returns. So a bank's revenue comes from the returns earned on those assets, which we commonly call interest income. And we're going to be speaking a lot of those stuff. And also, so for interest income, then we also have the non-interest income component, or those other revenue lines that are not driven by interest income, or in other words, are not related to interest income, even though they may be related to the drivers of the interest income, such as the loans and investment securities, because as business volume grows, you tend to have those revenues also growing, right? Okay, those revenues also growing. Now, so the whole idea here is the non-interest incomes here has to do with the fee and commission income, which we're going to say a lot about. The net trading income. Those two components of incomes are the other components that when we add to the interest income is going to give us a bank's revenue, right? Now, so if you look at it, if a bank is well managed, generally well managed, you'll see some level of stability in the interest income. But then, because of macroeconomic, issues or changes in the macro environment in terms of interest rate dynamics and all that, the bank's interest income may not be stable. Of course, it may exhibit high variability over time. And that high variability, since interest income constitutes a significant portion of a bank's revenue, it gets translated into profit. And the profit tends to be variable as well. And let's just put that aside. Let's get into the ones that are even very difficult to predict, like the net traded income, right? Income from trading activities, treasury services, and all that. That's another area that's quite volatile, right? So in general, banks' earnings or profits generated by banks tend to be extremely volatile, or the variability is extremely high. And because of the high variability in this area, it affects the reliability in terms of whether we can even forecast earnings reliably. So putting all this together, I just want to summarize that for a bank, what actually measures or helps us to assess the health of a bank that investors are quite interested in is the capital, whether there is sufficient capital. And that is a matter of the equity the bank has. So when we talk about the health of a bank, or what investors should really be concerned about, what equity analysts should really be concerned about, is the capital strength, or in other words, the equity. That's what they are really, really concerned about, right? Great. So the equity is the one that absorbs any potential loss, as I mentioned. So the bank's balance sheet businesses, or banks are balance sheet businesses, as I said, and their equity, the book value of equity, meaning the equity on the balance sheet, is the ultimate shock absorber against crisis. At the end of the day, if there's any problem, if the economy is going bad and all that, if the bank is suffering, where all the losses are going to be contained is equity. And the question is, do you have enough equity to absorb the losses? Now, so if investors know that that is where the problem is, because if they invest their money and they wake up the following day and they don't have any money, that is maybe a function of the equity, right? The bank is wiped away overnight or over a short period of time, however, they will not be happy. So what they will be concerned about when they're trying to put a value on the bank is the equity component. Now, so equity is going to drive everything. I mean, when I say, I mean the sufficiency of the equity or the adequacy of the capital is what I'm really talking about here. So the investors will then be interested in determining the price or the price risk. Investors will tend to price the risk then per unit of a book value. In other words, the price will be determined in relation to the book value of equity and not necessarily the more variable element, which is earnings. So what then do we see? or what conclusions can we draw? And I want to say that the things I start talking about here is quite a bit confusing, especially if this is your first time being exposed to the financial market. So you may be wondering, what's going on here with all these multiples? We are going to go back to that. We're going to start everything from the very basis. I'm just making a case for a bank, right? So we tend to focus a bank valuation on price to book multiples rather than price to earnings. You see, we may not really care about price to earnings because of the significant variability in price to earnings. But does that mean that earnings doesn't matter? No, earning actually matters. But what we're going to be doing, or what we are trying to say, is that if you plot the earnings of a company over time, which we'll be looking at another time, and you'll see that there's significant variability in the earnings. And what you can do is that you can plot earnings per share or just total earnings, because sometimes plotting earnings per share is a bit confusing, because somebody will look at it and feel like, okay, what measure of earnings are you looking at, number one? And number two, whether there had been new shares issued along the way, maybe some right shares or bonus shares that could affect how the earnings per share is calculated. So you can actually put in basis on earnings, total earnings, and just plot over time. Even look at our environment here and see how the profit over time was, up and down there and there, well, especially during the DDEP program. The outcome of the DDEP program. So we tend to focus a lot on price to book value. But does that mean that there are no other methods to price in a bank? No, there are. We are not discounting, or we are not putting aside the discounted cash flow model. We're going to look at discounted cash flow model, but we're going to be looking at it in a very special sense. We will look at it in terms of discounted earnings rather than discounted cash flow. And there are things we need to do. Once we start using discounted earnings, then we need to be concerned about the fact that capital is a key thing to talk about. So as I said, I'm just setting a sentence. I'm not actually saying that we've not started doing valuation. We've not started talking about multiples. But I'm bringing this in so this should get you thinking, okay, about what analysts actually think about when we talk about a bank. So you see that going forward, what we're going to be doing in all our modeling work is that we want to determine the book value of equity over time. Okay, and there may be adjustments we may need to do against the book value of equity if the book value of equity is not reflecting the true equity. Look, guys, forget about the fact that auditors have audited account. Yes, they've audited account, but for valuation purpose, we are looking at something beyond this what they have done, right? So there could be additional adjustments that have to be passed to the balance sheet again, right? And in some cases, the balance sheet may have to be restructured entirely for the valuation to work. So we're going to spend a lot of time on that. I think this is a question, two people ask question. Assets that can be easily converted to cash. What is recognized as liquid asset? Okay, thank you. Someone answered that question. Thank you very much, Nelson. Now, so bank valuation. Why do we do bank valuation? Now, so number one, so investors may need to identify undervalued banks, right? Which banks are trading at a cheaper price that we can buy? You think that the bank's value on the stock market should be 5 cedi per share. It's at 3 cedi per share. Okay, so we want to identify said banks. And versus overvalued banks, if some banks are, the price is too high and we want to sell them off, right? And so because when the price is too high, the reason why we intend to sell them off or decisions are made like that is that over time, with demand and supply pressures, we expect the price to revert back to its fair value, or the stock price will revert back to the fair price. Because of that, you want to sell it now so that when it revert back to fair value, you can buy it back again. So you are selling it at a higher price and buying back at a lower price, and the differential is what you make as a gain. Those who are involved in or interested in active portfolio management tend to do a lot of that. They buy stocks, or they buy, I'm going to use the word stocks than shares, right? They buy stocks that are cheap on the market, or cheaper stocks are bought, expensive stocks are sold. So if they're holding let me take it back. If I say cheaper stock, I mean they are cheaper than what the prices should have been trading. And if I say expensive one, I mean these are mispriced, okay? The price is too high. We expect it to be lower than what or the price we currently see on the market. Now, so for portfolio management, that's the first one. The second point here is that the multiples actually determine acquisition prices, often used in acquisition prices. The price to book multiple is used a lot of times when companies are being purchased. So we can come up with the transaction price or the final price to book. And of course, you can get a lot of this data when you visit Capital IQ, right? You get a lot on this. Another point here is this. For example, if we use a price to book, the price to book multiple, this is what it's saying, is looking at the price or the value of the bank on the stock market, okay, the market price of the bank, let's put it that way, the market price of the bank or the value of the bank from the perspective of market participant, the price at which the bank is trading multiplied by the number of shares outstanding, all of that things being equal, right? That is the value of the bank from the perspective of the market. In other words, we call this the market capitalization. Now, that is the P. The B, which is the book value, is the value of the bank's equity on its balance sheet. What is the total equity on the balance sheet? The total equity on the balance sheet. Now, if the value of the bank from the perspective of the stock market, or as per the stock market, whatsoever the value of the bank is, if it is higher than the value of the bank on the balance sheet, then it could mean that the bank is overpriced. But that may not necessarily be the case, but I'm just setting the argument. So what it means is that the market is pricing the bank at a higher, or putting the bank at a higher price than what the bank itself is worth as per the balance sheet. Now, you see, sometimes when you look at such argument, you feel like, well, this balance sheet, things are at book value. Oh, yes, definitely things are at book value. But one thing you need to know for banks is that the bank's balance sheet is driven mainly by the loans, deposits, investment securities. Those tend to be the big matters on the bank's balance sheet in Ghana. We're going to see it soon. Now, those are the big matters on the bank's balance sheet. Now, since they are the big or the significant matters on the bank's balance sheet, and if a bank should fail, those are the things that will determine it. Then the question is whether those things actually are at fair value. Are they at fair value? Oh, yes, and you can see they are fair value because the deposits are the deposits. When you talk about the loans are measured to fair value on a regular basis, right? And the investment securities now they are even marked to market, so they are at fair value. So whichever way you see it, the key items on the bank balance sheet are already at fair value. So, but that also doesn't mean that the fair value measure that we have for the items on the balance sheet is sufficient to give comfort to investors. So they will still want to assess whether those fair values are true fair values. Okay. Now, so the value from the stock market could still diverge from the values from the books. Now, if the value from the stock market is more than the value on the books, which I mean the book value of equity on its balance sheet, then we say that the price to book ratio is greater than 1. But if the value on the stock market is lower than the value of the equity on its book, then we say the price to book ratio is lower than 1. Now, if the two are the same, then the price to book ratio is exactly 1. And so, but we rarely see something like that happening. So we then, maybe some sound from the background where I am. Okay, so we tend to look at that and use that as base to make decisions, right? Now, we can also look at the stock market and the regulator can infer a bank's maybe solvency from the perspective of the market as well. Because if the regulator looks on the market and realizes that the price per share or your stock price has dropped significantly to the extent that the price to book ratio is nothing to write home about, the regulator may be alarmed. And if the regulator is alarmed, what they'll be taking out that, hey, look, what is happening? Is it that the market is extremely inefficient, that it's not even taking in information at all, or is there something fundamentally wrong with the bank? Okay, so if something fundamentally wrong with the bank, then it could mean that the asset on the bank's balance sheet may be overvalued, and there may be a need for some impairment or something. So some form of diagnosis may be conducted into this. to investigate this issue, right? Good. That's what I'm trying to say here. Now, so I did some interbank comparison here. If you look at the price to book ratio of GCB, that's about 0.42 times. And how we read this is this. We can say that of course, well, I made reference to some collapsed banks by the time I should have dated it back to 2015. But if you look at UT Bank, it was a special case, right? In this situation, that's a bank that's listed on the stock market. Then I should have dated this back. I dated it to 2017. If I move it back a bit, chance of that. Sorry for that. Now, if you look at GCB trading at 0.42 as it stands now. This is based on the 2024 published financial statement, right? And the stock price to us at the end of the year 2024. And so that's what I use. I just use the year-end price. I didn't adjust. I didn't, people can do the last quarter, average price for the last quarter and all that, but I didn't do that. I used the price recorded on the last day of trading, right? And that is 0.42. Now, what it means here is that for every 1 cedi of equity of the bank on the bank's balance sheet, the market is placing a value of only 42 pesos. I'm taking it again. The 0.42 times book value just means that for every 1 Ghana cedi of equity, okay, on the balance sheet of the bank, the market is valuing that or is placing a value of only 42 pesos. So the market feel like, oh, look, that 1 cedi equity, I can buy it for only 42 pesos. Okay. Now, if you look at Standard is tumbling high, right? 1.51. So for every 1 cedi of equity that Standard has on its balance sheet, the market is placing a value of 1.51 cedis. So the market is pricing Standard expensively compared to GCB. Now, EcoBank is actually below GCB. Now, I selected these 3 banks, and I'll tell you why later. GCB and EcoBank are part of the top 5 banks, okay? The top 5 banks in Ghana here, right? Standard is not part of the top 5. And if I say the top 5, I mean in terms of deposits and total assets, right? Good. But I brought in Standard because I don't want to just deal with 2 banks. So that's one reason. Number 2, I brought in Standard because Standard has a divergent view. I don't want to just work with those banks with price to book ratio less than 1 and make a conclusion. The Standard tends to be a special case. We'll get to investigate why. If you look at the price to earnings ratio, GCB tends to be 1.4, still higher than EcoBank of 1.24. You see the resemblance here. But when it comes to Standard, it's extremely high, higher than Standard, right? Higher than both GCB and EcoBank, as we saw it also on the price to book. But I told you that, look, in valuing banks, not quite a fan of price to earnings, even though we consider it in the calculations and all that, but nobody actually spent time giving any significant weight to price to earnings, especially in jurisdictions or environments where earnings is quite volatile, right? Look at a key measure here, return on equity. Return on equity is extremely high. 2024, GCB recorded 35% return on equity. And let me tell you how I calculated this. So when you go back to calculator, you don't get the same thing. You don't really believe me much. What I did was this. I took the 2024 financial statement, the net profit, and I divided it by the average equity between 2023 and 2024. So that's what I did across. So 35% for GCB, 35% for Standard, and EcoBank 32%. And you will be wondering why 35%, a huge ROE like this, and you're still getting a price to book ratio of 0.42. It's too low. And one thing I wanted to do before the program, of course, which I'll be bringing later, is that I wanted to look at other markets like advanced economies like US and all that, and the UK to see the average return on equity of some of the commercial banks out there. And I won't doubt it if their return on equity happen to be extremely lower than what we have here, but it may be trading at a better price to book ratio. And you are going to explain, or going to see what the problems are, or what is actually accounting for that. Think about an NPL here. Oh, I didn't include that of EcoBank. But look at the GCB NPL, 15.06%. NPL is the non-performing loans, right? Ratio, the non-performing loan ratio, 15.06%. And Standard is 24.77%. At least these are figures I picked from their books, right? The 2024 accounts. And EcoBank, of course, I've excluded that, of course, but in later sessions, we are going to come back to all these things and we are going to diagnose them. We will decompose each of these variables and look at the key drivers of them. And so if you look at it, you'll be wondering why huge ROE, but then that is coming at a cost. The NPL is also equally high. So if you go to a market that is more stable, you will tend to see the NPL being low, and also you see ROE also being low, and you end up seeing a better price to book. You may not, right? So the fundamental of the country or the economic circumstances in the country also affect these variables. So let's not run into conclusion to say that because the price to book ratio of GCB Bank, EcoBank are below 1, therefore they are cheaper stocks to buy. Not necessarily. It may not be the case, right? And also to say that, oh, Standard is doing well, or Standard is at 1.51, therefore, I think it's too expensive, it's going to go down because look at Standard, the NPL is 24.77. I think this is just too expensive. You may never know. It may continue, right? So if you look at it at first glance, you may actually consider some of these banks to be cheap opportunities, right, to buy them. But what we're going to do is that by the end of this program, we will understand what is behind or the factors driving each of these variables. So I'm done setting the center stage for the lecture. So I've taken my time to really set the stage in terms of what analysts look at and what actually drives them. Of course, tomorrow when we deal with economics, and there are a lot of things I'll be bringing out in the economic class and to add to this as well. And all these things are very important for valuation. Someone asking a question, just to understand, does the market pricing of a stock take into consideration the earnings capability of a bank going forward? If yes, kind of a bit confused why price to earnings is not really a good metric in comparison to price to book. Just thinking of forward price to earnings ratio, mimicking this. Well, that is true. Of course, the market takes into consideration, but you see, the whole thing is that for banks, you may never know what happens in the future. So it's risky to actually depend so much on future earning capability of a bank because the bank tend to be pro-cyclical, right? The performance of banks tend to be pro-cyclical. In other words, when we have these swings in a business cycle, of course, the banks tend to align, okay? So if the economy is doing well, you may see the banks also doing well. If the economy is doing terribly bad, you see the banks also mimicking the same scenario. But hey, let me say this before we continue. I'm going to say it tomorrow, but when the economy is doing badly, we see interest rate and all those things rising. You tend to see the banks making money, but that is just in the short term. Because in the medium term, there may be companies that will start defaulting on their loans, and that may mean that the NPL will start rising. If NPL start rising, and then the interest income may tend to drop because a lot of loans may not qualify for accruing of interest income on such loans. Now, the reason why I say the price to earnings is not quite of a good metric is because of the perceived variability in the price to earnings. It doesn't necessarily mean that price to earnings will not be used. What I mean is that oftentimes it's extremely variable. It's sensitive to fundamental value or insensitive to the cycles. So it tends to be it tends to be difficult to measure or less reliable. But we'll be dealing with other models like discounted cash flow models, like intrinsic value models, like residual income, which is even a better model than to compare to even discounted earnings and all that. So a lot of things will become clearer and clearer as we move forward. I understand you're talking about forward P's and all that. That is true. Forward P's can still be used, but you know, whatsoever we're doing here, we are looking at our environment here as well. Ghana is a special case. The market is quite turbulent. Let's look at just the past 10 years, what have happened in the banking sector. Just the past 10 years. Of course, UT Bank and Capital Bank collapsed. And then afterwards, we have the cleanup. The cleanup, several banks were wiped off, right? Because of capital inadequacy. And so the perceived risk in the banking sector. And then also the minimum capital was increased. And who knows, in the next few years, they're going to revise that, because the time they issued the minimum capital requirement of 400, the revised one, 400 million. I think the estimate rate was around 4 cedis to $1. And so it was equivalent to $100 million. So just think about today, the estimate rate is around 15. And if you want to match that today, if you want to stage that at current rate, then you're going to be doing, since we have 4 cedis to $1, and that gave us 100 million that time. If you convert 100 million today, at today's price, that's going to be 1.5 billion Ghana cedi. Suppose that is done. It's going to change a whole lot of things. Some banks may need to consolidate and all that. It may result in some banks collapsing. There are a lot associated with the earnings. We'll spend a lot of time on this later to talk more about that. But even think about the issue with them. The GDP and how it affected the bank's P&L. Several banks need to write off a lot of loans and all that. And so it makes earnings actually quite variable. We would look at the trajectory of earnings tomorrow when we talk about economics and the earnings on the market. We are going to be working with real live data. Look, this lecture I'm going to be running, the understanding we have is that we don't want to run this with there's some theoretical data. Real life data, like what I've just showed you here, the real life data, what is happening on the market. So you can actually see what is. All right, thank you very much, Edwin, for that question. Great. Wonderful. Any question? Now, so we just covered some concept on valuation perspectives, or when we talk about why the business model is your blueprint. And so we've exhausted that. Good. Now let's talk about the banking sector, the Ghana's banking sector. And we're going to look at this or view this through a valuation lens. When we look at the structure of the banking sector here in Ghana, we tend to have, currently we have about 23 commercial banks and 7 indigenous banks we have. And the total assets of the entire banking sector as of December 2023, and just to say, this total asset actually excludes banks like UMB, ADB, and NIB. Okay, and because NIB's accounts are not public, I think UMB as well, ADB tends to be public, but in compiling this, I limited it to just 20 banks out of the 23. The difference or the differential will not be that's significant, of course. Now, so the total assets, the banking sector, are about 254 billion for those 20 banks. And you see soon why I said even the exclusion of these banks will create much problem, right? You see it soon. So, and the assets or the banking sector asset has been growing at a CAGR of 21.4%. And to those who are hearing the term CAGR for the first time, CAGR is compounded average growth rate, the compounded average growth rate. So it's kind of like if you take the compound interest formula, right, and you get a present value, and so to get a future value, you take the present value, and then you do present value into brackets 1 plus the R to the power N. Okay, so present value times into bracket 1 plus R to the power N. And so when you do that work, the arithmetic, you tend to get a future value. Now, so when we say CAGR is like, now, can we come up with that R? What is that R that could give us a certain desired future value, given a present value and a tenor, right? So we make the R the subject. Let's put it like that, making the R the subject. Once you make the R the subject of the compound interest formula, that R is what we refer to as a CAGR. So is the rate at which something is going to be compounded, that constant rate at which something will be compounded, such that it gives us a certain value in the future. We'll be talking about some of all of these analytical tools on Friday. But what this is trying to do is that we look at the total assets of the banking sector. That's for the 20 companies or 20 banks. And going forward, I'm just going to say the sector. And you look at the total asset in 2019 and also look at the total asset in 2020. And then we look at the average rate that we can compound the asset at 2020 such that they give us the value in 2023. That's what we call the kicker. Someone raised a question. Let me check to see what is that. Is there a reason you have a preference for relative valuation compared to absolute valuation? Yeah, you see, I'm going to talk about that. I think before we start the financial modeling work, after the economics of banking, I'm going to speak a little bit about, I think it will even be tomorrow, that I'll speak a little bit on the valuation preferences. But what I want to say here is that when I started this lecture, actually, so why are we going to spend about 11 days doing this if it's just go price to book? Everybody should just pick the price to book and just multiply, right? But I'm going to make a case for that. There's a reason. But I'm also not saying that the absolute valuation models are not correct. I'm not saying that. But I can use the price to book ratio or the relative valuation models, and that's what I mean. Example is the price to book ratio for those of you hearing the term for the first time, because we are here to get into it in later sessions. I'm choosing that because I can actually explain the absolute valuation models using the relative valuation models. In fact, the fundamental drivers of value are common to both. And I'm going to demonstrate that for you to see that the key factors influencing value, which basically are the cash flows and the risks associated with the cash flows, those two items there, or two factors there, or two variables there, tend to be present in both relative and absolute. So I'll answer those questions when I get there. So the total asset is growing. Look at assets growing at 21.4%. This is a good market, right? If you look at sector deposit, 27.2% annually. Okay, annually, if you take the total deposit for a sector and you compound it at 27.2% over a 4-year period, that is from 2019 to 2023, you get 27.2%. Or sorry, you get 195 billion. And you're going to be compounding at 27.2%. So, in fact, if you look at these things, it tends to be it's tend to be stable over time. The growth tends to be stable over time. In exception of the DDP that affected the assets, for the deposit, it tends to be growing consistently at a constant rate. So we can actually look at it and say, hey, okay, I've seen the sector growing like this, the entire sector growing at this rate. And maybe I want to value a bank and I want to see the position of that bank in the sector. Is that bank part of the top 5? Is it part of the top 10? Okay, so if it's part of the top 5, I know they are the ones driving the entire market. So it makes sense to use the growth in the sector to justify the growth projections for that bank. So whatsoever we're doing here, we are not just throwing figures to look at what is happening in the sector. It's going to form basis of our projections, and all that we're going to be using industry figures actually to justify whatsoever we're going to be doing, right? Now, if you look at the profit before tax of the sector, it's about 12 billion. The profit before tax is 12 billion for the entire sector in 2023. Of course, in 2022, it's lower than that, and I'll show you too. It was lower than that in 2022, and of course, you know the reason. The DDP affected that. And profits have been growing at a CAGR of 24%. That's a good market, right? Why won't people invest so much in this? If the market is growing like this, if the entire sector is growing like this. And of course, if you check some individual banks, they're also growing at similar rates, right? Good. Now, moving forward, if we talk about the market share and the concentration trends here, let's look at just this. These are the top 5 banks on the market. These are the top 5 banks. And we are considering them to be the top 5 because of the, we are looking at them as the top 5 because of their assets and deposits. And there's something I want to say here. Maybe I should have included here. The table above here is for 2024. And the item below here, I clearly specified about 2023. Let me explain why the data below, in the ones in the rectangular boxes, are not 2024. Now, some banks are yet to publish their financial statement. I didn't see some of them. I saw a number of banks, but I didn't see some banks' financial statement published. Now, because the financial statements are not published, it's difficult for me to come up with industry. So, or the sector. I tend to just focus. But I saw the top 5 banks publishing this, like EcoBank, GCB, Stanbic, ABSA, Fidelity, right? They have published this. Now, what I want to say is this. If you look at what is below, let's talk about the rectangular boxes. One's below first. And 2023 total assets, 74% of the total assets is actually contributed by top 10 banks. So top 10 banks are driving 74% of total assets in 2023. And the same top 10 banks in the country are actually contributing 75%, or they're actually controlling 75% of the sector deposit. Top 10 banks are controlling that, 75% of the sector deposit in 2025. So just look at the degree of concentration of the deposit. It's sitting in the hands of the top 10 banks in the country. Now, and the question is, what are the top 10 banks in that 2023? You see, the difficulty I face in putting some of these things together is that if you look at 2023, if I take 2023, the top 5 banks are still holding their position. In fact, in 2022, we have some top 5 banks at the same level. So if EcoBank was the first in 2022, being the second, Stanbic being the 10th, ABSA being the 4th, and Fidelity being the 5th, these same banks occupy the same position in 2023 in terms of total asset and deposit. But when you come below the top 5 banks and start looking at something like the top 10, so below the top 5, then you have the 6th, the 7th, the 8th, the 9th, and the 10th. That is where you start seeing the noise. So you see in 2022, Access Bank is ahead of Standard, and 2023, Standard is ahead of Access Bank. Okay, so those are the difficulty associated with this. So the noise and the competition is really tough there. But in the top 5, of course, the big boss or the big boys are maintaining their position. Now, so the top 5 here, in 2023, is the arrangement. In 2024, look at arrangement again. But you see a bit of a change. I think I noticed when I was putting these together, is this tool here? You'll see GCB outperforming EcoBank in 2024. EcoBank's deposit was 31,199. GCB's deposit increased 34,067. So GCB now is the leader in terms of deposit in Ghana. GCB is the leader. Now, in terms of assets, EcoBank is still maintaining its position. That's the reason why I still maintain their positions like this. EcoBank is still holding on. But the difference is not that much. Great. And one thing I fail to provide here is the currency, okay, and the level to which I've rounded this. I've rounded this to the nearest million, okay, the nearest million. So these are in billions. These are in billions. So the difference in the total assets of EcoBank and GCB is 3 billion. Now let's look at the return on equity of this bank. Fidelity at 44%. Imagine. So if Fidelity gets listed on the stock market today, just imagine the price at which it will be traded if they get listed on the stock market today. Okay. Now, because ROE is one fundamental driver of value, and we're going to see it in subsequent lectures. I think somewhere next week, we are going to see ROE, how ROE is driving valuation of the banks. So Fidelity, of course, is the one topping, and it's followed by EcoBank, and then GCB. GCB, even though GCB is very big, GCB is still doing really well. Their ROE is quite healthy as well. Stanbic, 33%. ABSA, 33%. But one thing we can say is that all the big banks are doing quite well. You may be wondering that, oh, well, they are big banks, so of course the equity may be really high, so the base is really huge. Of course, the earnings they will be making on that will be insignificant compared to the equity base, and therefore their return on equity should be lower because they are stable banks. Of course, but look at the return on equity; it's too high. So if you have this high return on equity, if we are to look at this compared to some banks in an advanced market, and which we'll be looking at in subsequent lectures, you'll be wondering, then why the lower valuation? Why the price to book being extremely low? Right. Standard is not even part of the top 5 banks, but then Standard is having a valuation of 1.51, right? I mean, price to book ratio. Good. You uncover this. Any question? No question in the chat. So I think I need to proceed. Good. So I want to talk more about something again, still on the industry, for you to get what is happening in the industry or in the industry there. So I'm going to be using industry and sector, right, interchangeably. Right. So the customer deposit growing at 27%. And you see this consistent growth. Look at this. In 2019, we have 74.42, and that has grown to 194.67. But somebody will look at this and say, well, in dollar terms, how much is it? Because if we look at the exchange rate in 2019 and look at the exchange rate in 2023, and we restate all these to a common exchange rate, you realize that there had not really been any significant growth in the customer deposit in real terms. Let me call it real terms. Real terms. Guys, you see, inflation is affecting a lot of things in the country. Deposit are also affected by inflation. But the reason why I'm just saying that if I use exchange rate and I convert these to see them, maybe to compare over time, dollar to dollar, over time to see whether there's growth. The reason why I'm saying that is that within the exchange rate movement, we can actually interpret the movement to be made up of inflation. Okay, inflation differentials in the two countries tend to explain the relative price of the currencies in terms of each other, or in other words, the exchange rates. Now, so we see this significant growth, 27%. So which I quoted earlier, which you see. The loans are 13%. Of course, we know why the loans are not really growing. Deposits are growing. The loans are not growing. Where is the money going to? You can see it clearly here. It goes to investment securities. Yeah, because the banks are making money. They're getting the money. But then they don't want to put it in loans because the economy is not quite great for them. So they always want to run to safety. And the best place to go is the government. Then what happened? So we saw the investment securities being 46.85, then increased to 49.27, then 75.28. Then the DDP set in. And then the revalued amount is 57.16, even lower than what we saw in 2020. Good. Good. A moment, guys. Okay. Now, so DDP actually affected the investment securities, of course. Now, one thing I also want to say is that about 49% of the sector's investment securities holdings are controlled by the top 5 banks in 2023. I don't know why I didn't bring the 2023 here. But if you go to the loan to deposit ratio, I'm taking you through these things because these are going to affect how we come up with assumption when we are doing financial statement modeling for banks. So we need to be aware of the industry. The loan to deposit ratio here, over time, 47% loan to deposit ratio dropped to 41, it dropped again to 39, dropped again to 37, then dropped finally to 30. It tells you that a lot of money then get like moving away from loans and entering somewhere else. And I believe this was a trend that Bank of Ghana studied and we're like, hey, look, we are hitting something. The market is going somewhere. We need to do something about this. We need to bring in a regulation or revise our existing regulation such that banks are forced to lend to the private sector. So instead of lending to the government, they should rather lend to private sector to boost the economic growth. So they were lending to the government, resulting in the government being overburdened, and then we have the DDP. Lend to the private sector. So what did they do? They brought in and they revised the cash reserve ratio, of course, to force banks to start lending to the private sector. So if you have a lower loan to deposit ratio, you get penalized. If you got a higher loan to deposit ratio, then you tend to have some regulatory relief. If I say regulatory relief, I mean you tend to have a reduction in your CRR. Now, the last part, I believe, of the sector performance here, I want to show you some info on the P&L side of work. Now, so when you look at the earnings, or what I want to call here is the interest income of the bank. And I told you, of course, that the interest income is actually the main component of revenue for banks. The interest income is the main component of revenue for the banks. So we are going to spend a lot of time on interest income because it's actually contributing more to the revenue of the bank. You see the growth over time, oh yes, but then you see that, there's a growth, but what is dominating is the investment securities. 56% in 2019, 58% 2020, 64 in 2021, in 2022, 55, and then so it dropped from 64 to 55, and we know why. The GDP caused it, and then it dropped again to 54. Now banks tend to now be lending to the sector. So you see that in 2023 there has been some growth. Interest income grew significantly from 22 billion to 30 billion. That is not the end of the story. We saw that the growth actually has been shifting towards the loans now, even though significant component or proportion is still with the investment securities. Of course, if we look at the 2024 numbers, you tend to have a better view. One thing I want to see, when you work for a company or wherever you work, make sure that you have this industry database down, right, which you regularly update. Now, so when you look at the various groupings, the sector profits, I talked about profit after tax, 7.5, and that as a CAGR, we have that the top 5 banks, this is the total profit after tax, and look at the top 5 banks, total profit after tax. In fact, if you take top 5 banks as percentage of the sector, which of course I didn't do that calculation here, but I can quickly do it. If I take the top 5 banks are 4.5, and you divide it by the total for the sector, that's giving you 60%. So 60% of the profit in the banking sector is actually driven by the top 5 banks. Right. You see the average earnings yield here at 17%, and this is the average yield on the asset. Not too high, but not bad. It's actually lower than the 180-day bill here we have. And average lending rate is 25%. It's lower than that as well. The non-funded income, what we call non-funded income, is the same as the non-interest income, like the fees and commission, the net trading income, all that as a percentage of the total income of the bank. And total income of the bank has to do with the revenue plus other incomes. You have about 23% of that. Not too bad. Now, so the average NIM, this net interest margin, we're actually going to be decomposing all these things. I'm just introducing you to them for the first time, so that when you see them again another time, it doesn't appear as something which is quite foreign, right? There are reasons why I do that whenever I run these programs. So the net interest margin is basically the interest earned on the assets minus the interest paid or the interest expense that is accrued on the deposit or the sources of fund, right? The interest earned on the asset minus interest that is yielded on the liabilities divided by the total assets. And I told you, whenever I talk about asset, I mean the investment securities plus the loans, or in other words, the earning asset. That gives us the NIM. So if the NIM is positive, it means we are earning good return above the liability. If the NIM is negative, we are in big trouble, because what it means is that it costs us to raise money than what we got out of the asset we created, out of the money we bought, we raised. Good. Let me see whether there's any question. Then we move to look at product and economics. And the product economics is quite an important. Let me see. No question here. Now, so let's look at a structure of a bank. Generally, when we talk about the banks, the commercial bank, we tend to see them be structured around three main businesses. We have the retail, we have the commercial, and the corporate. Usually, you see the investment bank inside, sometimes the treasury standalone, or sometimes report under the corporate, right? But it's often standalone. I've exempted the treasury for here, but you can actually see the treasury actually into corporate banking in some cases. But the treasury tend to stand out in several of the banks as well, right? They have the treasury function separately. Now, so we have the retail banking, and retail banking, which some banks call personal banking, commercial banking, which other banks, some banks call SME banking, the corporate banking here as well. There's some of the groupings, right, that we tend to see. So the deposits are mobilized, the loans are granted to each of these business units. What it also means is that we can raise deposits from retail, and then those deposits got transferred to maybe create loans for commercial, right? Or we can raise deposits from corporate and use it to finance loans that are to be created or meet demands for loan creation in the retail market. Of course, when you work for a bank, and you tend to see that there is a form of transfer pricing in this regard, because if you are moving deposits that are mobilized in retail from the retail market, and you are moving into commercial banking, the retail guys will say, hey, we need to charge you something, right? So internal transfer pricing, so you pay us something. But then when we see things at the level of a bank's balance sheet, all those things cancel out. The transfer pricing, the profit made, transfer price, they all tend to cancel at the level of the bank. But when you work for a bank, and for management accounting purposes, you tend to see these things reported for performance measurement purposes, right, in the banks. Great. Now, let's talk about the retail banking. And so, as I mentioned earlier, the retail banking is same as the personal banking, right? Now, so the key revenue drivers actually from retail banking are the mortgages that are given to individuals, personal loans, and the fees, the fee income arising from maybe the use of the bank's mobile apps and all that. So you see, the first two items, the mortgages and the personal loans, tends to be the sources of interest income from the retail side. And the fees, like those are mobile money, right? Almost everyone, I believe, have banking apps. Apps used to do mobile banking and all that. So mobile money withdrawals and all that, and maybe ATMs and individuals, like, yeah. So those fees come into the banks, right? So we have the interest income component, we have the fees. Now, it also has cost challenges because several of these banks that set up branches are for retail purposes, right? Traditionally, the branches are set up for retail purposes. So you see the branch network cost, digital competition is also a challenge to the bank because now MTN Momo is there. People put money in mobile money instead of putting it in the bank, right? People tend to save money on mobile money and other platforms that we see today instead of keeping the money with the bank. So on a retail level, things are changing. Fundamentally, things are changing. The technology of fintech is quite disrupting the market, and that is a key consideration when you are determining valuation and all that, because these affect the stability of the bank, right? Affect the stability of the bank as to whether the bank will be able to mobilize deposits sufficiently to create new loans in the future. Otherwise, if they find it difficult to mobilize deposits, what are they going to do? They'll increase interest rates so people they can attract funding. Hey, we're going to increase interest rate from 10% to 12%. Why? Because we want to attract people. They don't want people to keep the money, keep on keeping money, mobile money accounts. They want it to be brought to the bank. But if those mobile money operators like MTN tend to work with a particular bank, that bank tends to do well in terms of benefit from that. But then those ones that are not working with tend to be the ones to suffer. Some of these banks also created the digital platforms so that they can actually match up with MTN and also compete with MTN on that level. So, of course, all the valuation impact here, generally, I'm giving some basic stuff here. So, banks with high CASA ratios, if I say high CASA ratio, what I mean, like the total deposits they have tend to be significantly driven by CASA. CASA is current account savings account. Those of you who are hearing this for the first time, current account savings account. Because current account, banks don't pay anything on current account, right? So it's a cheap deposit, cheaper source of deposit, nothing is paid. Savings account, even what the banks pay on savings account is quite minimal, very, very low returns on savings account. And so higher CASA means that banks are actually having the majority of their deposits coming, or significant portion coming from CASA. If it's coming from CASA, and CASA doesn't really attract any cost, any significant cost like that, it tells you that the interest expense of the bank tends to be lower, right? So if interest expense of the bank tends to be lower, then it means that the bank's profitability is enhanced. All of that things being equal. When a bank's profitability is enhanced, where does it flow to? It flows to the book value, right? It flows to the book value. Now, then you start thinking, well, earnings flow to the book value, and how happens to the market, the price on the market? In a very good market, and analysts following the stocks and there, and things go well, of course, the market gets to understand the stability of this bank in terms of its deposit sold, and to know that this bank doesn't really carry significant risk on its balance sheet. The price to book ratio tends to be higher. Now, so I am not saying that the price to book ratio is higher or trade at premium. I'm saying it's expected to trade at premium. Very important. It's expected. There's this expectation associated with that. So the actual result may differ from expectation. Apart from the key economics there, and then we talk about also the competitive environment here. So I mentioned earlier the competition coming. So fintechs like ZP stealing fee income, right? I mentioned some of these things, and a number of these competitors on the market we see today. They are competing with the bank for the fee income. So it's kind of a struggle, and you have to struggle for survival. Good. Great. On this. Now, when we talk about the SME banking side, of course, the revenue drivers, and look, even before I talk about the key economics, for SME banking or commercial banking, the question is whether it's a growth engine or it's an NPL trap. NPL is non-performing loans. Because a lot of loans that have gone bad and that resulted in a number of these banks collapsing can be traced to SME. Of course, a commercial activity, if you look at the likes of UT Bank, the story is mainly around SME banking, right? The question is whether it's an NPL trap or it's a growth engine, right? Okay. Now, so if you look at the revenue drivers here, of course, trade finance activity, working capital loans to these SMEs. And the challenge mainly has to do with the high NPLs, right? The high NPLs associated with this, because these businesses are highly risky businesses and they could fail. The valuation impact here is that the banks with the SME focus are more likely to trade at a lower price book because of the risk associated. So, we are not saying that they are trading. What I'm saying is that they are likely to trade because the argument is moving towards that side. That what I'm considering or I'm talking about or what I imply by the risk discount. The competitive environment here, the winners tend to be those banks that are collateralized or that undertake collateralized lending, right? The losers tend to be the overexposed banks, or those banks that are overexposed to unsecured SME debt. Of course, a number of the banks that collapse, a lot of these have been the story behind the collapse of these banks. So we need to be aware of the environment. The last side which I want to talk about is the corporate banking side of stuff. So, of course, the revenue drivers, syndicated loans, and a lot of treasury services provided to clients in this space. And one big matter too is that these tend to be loans that are granted in a significant portion of loans in this area granted in dollars and all that. So imagine you grant loans in USD, and then the customer or the customer tends to be a very stable customer and a very reliable customer. What happened then is that when the cedi depreciates, you tend to have more, right? When converted back to Ghana cedi. There are also concerns around single borrower limit. Even if you have a good customer, you can go beyond some limit, right? A Bank of Ghana may not accept that for you to lend beyond a certain limit to a single customer. And the valuation impact is that the banks with diversified corporates are expected to trade at a higher price book ratio. They are diversified corporate, of course. If they highly diversified, it means that meaning you are working with several corporations across multiple markets, therefore increase the diversification. If a particular sector is not doing well, of course, another sector may be doing quite well, and that will use to offset that risk. Great. Now, on a competitive environment side, like the winners, look at EcoBank, tend to spread across the all African region. Then, so kind of like a Pan-African corporate operator, they will tend to do well, of course, because of that. But just think also about the FS risks here. Just think of a situation whereby a bank's, let's say 40% of a bank's corporate loans are actually made in USD, maybe a syndication run in USD. And that is one. Another one is think about even the structure of that syndication, a structure whereby payments are delayed and all that. The clients can go, maybe some moratorium periods or grace periods are given, such that the client can take his time to pay, maybe pay the principal later in the future. And this is a USD loan. And we know our Ghana currency or Ghana cedi tend to depreciate over time. Imagine what will be happening to the bank. So the risk to the bank will be extremely high. And that's likely to affect its performance as well. So it's not a straightforward thing to say that because you run corporate, because we tend to be a Pan-African bank, it should do very well. It also depends on a lot of factors, other competing factors, right? And that is economics for you. Great. Now, let me check if there's any question. I think this question in chat, is there a reason you have, no, then Caleb, yes, the obligo, yeah, single obligo limit, yeah, great. Now, I want us to talk about, I want us to look at a bank's financial statement. Just take an initial look at the financial statement of a bank. And we're going to be talking about this over and over again. So if this is the first time you have seen a bank's financial statement, don't be scared. Because we are here to talk about financial statement. Here, we're just taking an initial look, right, at the financial statement. Now, let's take a look at the financial statement. So I'm comparing a bank's financial statement to that of an industrial corporate, right? So to the left is the GCB Bank, a 2023 financial statement. And these are public banks. That's the reason why I'm using the financial statement. I will use a bank that is not listed on the stock market. So they are public banks. So the financial statement are public. Now, so if I take GCB 2023, this is the financial statement. And then FundMilk 2023, that's their financial statement. So here I'm looking at the balance sheet first, which is the statement of financial position. And all the figures are in thousands of Ghana cedis. So if you check the GCB financial statement, that of FundMilk, you tend to see assets. You see assets here. You see asset on that of FundMilk. You see liabilities here on that of GCB, and you also see liabilities that of FundMilk as well. But when we look at both the asset and liability, you see that for GCB, the asset tends to just be grouped together. There's no difference in terms of what is a current asset, what is a non-current asset. But when you come to FundMilk, you tend to see non-current assets separated from current asset. And one thing to also to note is that when you look at FundMilk's financial statement, the presentation of the assets is such that the non-current assets appear before the current asset. And it's not quite clear here when you check that off GCB, but same thing is going on. What is happening is that we want to present the most liquid asset first. And in other words, the presentation of the balance sheet for the banks is based on liquidity preference. In terms of, because banks trade on liquidity, it's a matter of liquidity. The health of the bank is a matter of liquidity. We want to see which assets are most liquid. Those are the ones that should come first. And the less liquid assets should follow, right? Now, so you tend to see cash and cash equivalent. That's the most liquid asset we are interested in. We see the non-pledged trading assets. We're going to get into each of these. You see derivative and financial assets. You see investments, and there is no figure there actually, right? Investment other than securities. The loans and advances to customers, advances to banks, investment in securities. You see it down there. And the final item I saw is property, plant, and equipment, right? Or property, equipment, and ROU. The RE is the right of use assets. That's where we have the lease and stuff, right? When it comes to the fund milk own, you see that we are not presenting these based on liquidity. We're actually looking at which asset will stay in the firm longest, right? No, liquidity is the opposite, right? The banks, we are looking at the most liquid first. But when we talk about the fund milk here, actually looking at the less liquid assets, and then it flows to the most liquid one. So the cash and cash equivalent actually tends to be here. Of course. For fund milk is not looking at, we want to look at our most liquid assets here. We're looking at the assets that can stay in the business for long to help us to create value in the future, right? That is it for fund milk, for total asset. When we get to the liability section, fund milk, you tend to see the current or the liability actually group, and then the current and the non-current liability. And when you get to that of the bank, we don't see something here. We tend to see the liabilities also grow in a similar fashion, right? The deposit tend to come first because those are the ones that are likely to result in the bank collapsing real quick. People will run to the bank and look for their money. And that's what we see. There's a run on the bank, right? The demand for cash increased significantly. And they have equity there. But if you compare the equity of a bank and the equity of fund milk, there's a bit of difference. Fund milk has stated capital, the bank has stated capital. Fund milk has written earnings, the bank has written earnings. Now, fund milk could have all this. There could be other components of equity. That is true. But when we come to bank, we have some other component that we may not or we won't see on a fund milk, like statutory reserves, right? We see something like credit risk reserve. We see something like fair value reserve. The fair value reserve, we can see the same thing under fund milk, but yeah, fund milk doesn't have anything like that. Other reserves could resemble that of fund milk, but the two reserves that you can actually see with fund milk is statutory reserve and credit risk reserve. It tends to be specific to banks. Now, we're going to be talking about all this later, but you see, think about statutory reserve as that additional capital that the regulator said, keep bringing in more capital, saving in some capital, so that even though you have the minimum capital requirement, but look, keep giving us more capital that you won't use for anything. You won't give that out to shareholders. In other words, the kind of capital we're talking about is when you make profits, you plow back some into the business. Think about it that way. The amount of profit you got to plow back into the business. Let's think about it like that for now, right? The credit risk reserve is a funny one. It's actually due to differences in how we estimate the credit risk associated with our assets. So how we quantify the two, the credit risk. We have IFRS prescribing an approach to doing that. That's what we call IFRS 9. IFRS 9 says that model the credit risk this way, what we call expected credit loss models or ECL modeling. And then we have Bank of Ghana also having these rules for estimation of credit impairments, impairment or whatever expected loss on credit. So until recently, that was estimated just on the loans. But during the DDP period, an assessment will have to be done on the investment securities as well. But I don't want to get into those special cases. The whole idea here is this: if the IFRS happen to be different from the provisions of Bank of Ghana or the requirements of Bank of Ghana, then there may be a differential. Now, so Bank of Ghana wants the bank to be conservative. So if you use the IFRS model and you do the ACL model, it tends to have a lower provision. Bank of Ghana say, look, you can report that lower provision, but you need to create an additional reserve equal to the difference between what the IFRS is giving you and what I'm giving you. We'll get into all those things. We're going to, that's going to feature it as, we'll do a simplistic work around the IFRS 9 modeling, but not really quite the details of the modeling, just something simplistic. And I'll show you how the movement is done. But that doesn't really affect the valuation to any extent like that. No, not at all. Now, so that is a balance sheet. When it gets to the P&L side of GCB and FanMilk, revenue by definition has to do with the income generated from ordinary activities of a business. When we look at how revenue is, the income generated from ordinary activities of a business. Now, all revenues are forms of incomes, or revenues are income, but not all incomes are revenue. So in other words, we can say revenue is a subset of income, right? So there are some other income that are not revenue. They are not revenue because they are not generated from the ordinary activity of the business. In other words, the business wasn't set up to generate those revenues, or sorry, those incomes. For example, if a bank disposes of its assets, maybe they have maybe some pickups, and they decided to sell the pickups, the profit they made on the sale is not a revenue. It's not a revenue because the bank has not been set up to be selling cars. Okay, or the bank sells a building, or maybe they discontinue operation in a certain town, and the branch there, they own a building, they intend to sell the building, and they make some profit on the sale of the building. That profit is not an income. It's not a revenue because the bank wasn't set up to be selling buildings, right? So it's an income made. The profit is an income. It's a form. It's an income, but not revenue. So oftentimes we classify all those things as other incomes. Now, so revenue is income generated from ordinary activities, so to say. When we come to a bank, the ordinary activity of a bank is to raise deposits and grant loans, and also perform other services like treasury, okay, and on transactions. Now, so those are the core activities of a bank. So from there, they generate income. Number one, the loans are created and the income generated is called interest income. So interest income is a form of revenue for a bank. Number two, the investment securities they invest in, they earn income on them. So that is also a form of revenue because the bank's primary business too is to invest in debt and, instrument and, trading, all those things, right? It's part of the object of the bank. Now, so you tend to see interest income coming from investment securities and also coming from loans. Now, so that's one part of income. Another one is from the transactions they run and all that, which fee and commission income is also part of revenue of a bank. Then we have net trading income because that's the treasury activities, right? Trading in fixed income, instrument, FX trading and all that. They're all part of the object of a bank. Okay, they are part of the object of a bank. You are granted a license to be engaged in a banking business, and a banking business is defined as follows. You see all this is defined in a banking business, but you see the sale of a building part of a banking business. If the bank the bank is not supposed to be doing that, right? Now, so those are the revenues of a bank. But the way we group the P&L of a bank, we don't group all the revenues together and have total revenue clearly stated. No. There are reasons why this is that. For example, if you come to the FanMilk financial statement, you see revenue and you see less cost of sales, and you see gross profit. You will see gross profit when you come to the bank. The bank, one source of revenue is interest income. Another source of revenue is fee and commission. Another one is net trading income. Someone may look at it and say, oh, why not just adding the three together and call it total revenue, and adding interest expense, fee and commission expense, and fee and commission expense together and just call it total or cost of sales, right? Or cost of revenue. And then you subtract that to gross profit. No. The whole issue here is this. The character of the revenue matters when we deal with banks. The character of the revenue. In other words, the economy is associated with the revenue. The interest income revenue, the character or the economy is associated with it is fundamentally different from what's associated with the fee and commission income. And the same thing applies to the net trading income. So we're treating them separately. So we are matching the expense or the cost incurred to generate this revenue to the revenue in question. The character of the cost and the character of the income must align. That's what we're doing here. So interest income match against interest expense, and that gives us what we call the net interest income. Then we match fee and commission income against fee and commission expense, and the net is called net fee and commission income. Net trading income is standing on its own, right? Now, to calculate revenue, we take interest income plus fee and commission income plus net trading income. That is the definition of revenue. However, you'll see some people doing this. They rather take net interest income instead of interest income and add it to fee and commission income and add it to net trading income. People do that. People have reasons why they do this. So it's difficult to just criticize people right away to say, hey, well, you may not know why the person is doing it. However, if we are to talk about revenue in a strict sense, that is not accurate. Now, the cost has to do with the interest expense, fee and commission income, and fee and commission income. Those are more, we can call them the direct cost, or whichever way you want to call it, cash cost. Now, so when you get into the bank's financial statement more, when you add all the revenue, subtract the cost, then you add other income to it, then you get an operating income. But again, to say that if you take just the total revenue and you add the other income to total revenue, then you get what they call total income of the bank. So that's the total income of the bank. That's the total income earned by the bank. So some further analysis can be performed. You can go ahead and take, let's say, interest income as percentage of the total income. So it will tell you the percentage of total income that is driven by interest income. You can also do another analysis where you sum up those components of total income that are not driven by the loans and investment securities. And here I'm dealing with, or I'm talking about the fee and commission income and the net trading income and other income. When you group the three together, it gives you what we call the non-funded income. Some people call it the non-trading, the non-interest income. But of course, the right term is, or the popular one, the more popular one, not the right, the more popular one is a non-funded income, because these income are not funded by the bank's assets. Now, so you get, when you do all this, you get the operating income of a bank. And when you come to FundMilk here, you're getting operating profits or loss. Yeah, you see, the issue here is this: when you come to FundMilk and all other these industrial corporates, you will tend to see that we have operating profit, and then you add finance income and then less finance cost, get profit before tax, and subtract tax. When you look at, or when you deal with banks, the finance cost of a bank is not present. We don't have a finance cost of a bank. Of course, you see, the finances or money is the raw material used by the banks, okay? And banks, they trade on leverage, or their business is entirely leveraged. So it's not like the bank is borrowing money from somewhere and that line item will have to be introduced on the P&L called finance cost or something. They are borrowing money from the public. In other words, they raise deposit, and also they could issue some bonds to raise money, and they could also borrow just normally from other financial institutions, and then they add that together and use to grant loans and all that, right? So it's not the same. It's not the same, right? So I saw some reports recently, recent reports, and people are calculating interest coverage ratio for a bank. No, we don't have that for a bank, okay? Because banks don't operate like these corporates. So you don't calculate such things for a bank. Like, another thing that people even calculate for banks is, you see somebody calculating something like EBITDA for a bank. EBITDA is earnings before interest, tax, depreciation and amortization. Earnings before interest starts, depreciation and amortization. We don't have earnings before interest for a bank because the bank's primary business is actually dealing with the very debt you are considering as that interest is paid on. So we don't have EBITDA for banks, right? We don't have EBITDA for banks. So we don't calculate EBITDA for banks. Now, so when you calculate the operating income and then the impairments, look, guys, if we say that a bank's asset is impaired or the loans are impaired, doesn't mean that the bank has lost money. It's a statistical provision, if I should put it that way, layman's term. It's just we just sit down and say, well, I've borrowed so and so money. EcoBank has borrowed, let's say, so and so group of people money. And they borrow them, they lend them money. I'm sorry for that. They've lent so and so money. So and so group of money have borrowed money. A group of companies have borrowed money from EcoBank. And then we sit there and EcoBank will be like, well, I know that these guys will pay me. Of course, they're in a good financial condition before I lend the money to them. But there's still some probability that the money may not be paid. So based on that, we can perform some calculation to arrive at an expected loss. We expect to lose so and so. And that becomes a provision you make. So next year, you're going to perform the same assignment again, the same exercise. And when you perform the exercise this time around, you may get a provision that is even lower than what you estimated the previous year. Of course, you may be expecting that out of the 100 million that we lend to these guys, only 20 million will not be paid. But then at the end of the year, nothing happened. The companies are still in good condition and they are still honoring the obligation. Then you do the calculation again and feel like, based on what I've done now, I think 15 million. So you see the provision you made in the earlier period has reduced to now 15. You see, these are statistical measures, and there are a lot of things that are used to run this. We will talk about the macro consideration like GDP growth and all that, because those are the things that affect businesses. And so we want to see whether businesses may face trouble that could cause them not to be able to pay their debt, right? And then the rest are accounting, right? The rest accounting. But before I talk about the rest, which I say accounting, like personnel expenses, depreciation, amortization, other expenses, those ones are specific to, or they're common to all companies, right? Simply GAAP. If I say GAAP, I mean GAAP is generally accepted accounting practices, right? And IFRS is a form of GAAP, right? So the GAAP applies across. We will be talking about how banks account for some of these things on the financial statement. I think tomorrow we'll deal with that. And you tend to see how bank accounting differs from the accounting that we see in traditional business, because that's going to affect how we do financial projections as well. I have a question. Attention, recording will stop in 2 minutes. You can re-invite to continue recording. Free, I don't know if you are aware of these.
Yes, please. Yes, please. That's a separate recording.
Okay, great. George is asking, can we say the impairment are probabilities of default and the NPLs the actual default? No. Impairment are actually not probabilities of default to say, well, the probabilities determine the probabilities affect both, of course. There is a relation between both of them. Okay, the impairment and the NPL. NPL is just a non-performing loans. The percentage of the loans that are non-performing, and there are various levels of non-performance. Some may be 100% loss provision, some just maybe just base. There are definitions, and we'll be looking at all those provisions later. I think I'll answer those questions better, George, as we get into the lessons. I think somewhere next week when we start the financial modeling and all that, we'll talk a bit about that. And so fundamentally, they are all the same. They are coming from a similar area. There are some non-performing loans that, or some loans that are non-performing, but you still charge accrue interest on them. Some you don't need to accrue interest on, and there are multiple definitions that we'll be getting into later. And Isaac is saying there is nothing like EBITDA for a bank. However, is it wrong to compute EBITDA for comparison purpose? No. What? You omitted the I. Earnings before tax, depreciation, and I was like, oh yeah, you can calculate earnings before tax, depreciation and amortization. Of course, you can do that. Just that interest there doesn't make sense. So you can do the EBITDA for comparison purpose. But sometimes when you talk about comparison purpose, what do you really mean by comparison? But if you pick two banks, a large bank and a small bank, how do you compare it? Unless you start talking about things in terms of ratios. And in fact, in which case I think absolute numbers wouldn't do or wouldn't take you home when you want to do those comparisons. But there are a lot of work we're going to be doing in terms of comparison. A lot of work we're going to be doing later in terms of comparison. So I think when we get in there, you'll see the beauty of all that, right? Great. Now, so let's talk about some key metrics analysts watch. Some key metrics analysts watch. I group these into three. And one is the profitability engine. And the second one is the risk radar. And the third one is a capital adequacy. Now, so when we talk about the probability engine here, a net interest margin is key. Of course, analysts are looking at that because I mentioned to you earlier that interest income tend to be the largest source of income or revenue for banks, and also by extension income for banks. And that's how it's supposed to be if bank is doing its business properly. Now, if I take the interest income and I subtract the interest expense, it gives me the net interest income. Good. Now, when we talk about a bank managing its assets and its liabilities properly, then we will tend to see, then we start talking about what we call the asset liability management of a bank. The asset here has to do with the interest income because the assets actually generate interest income. The liabilities are yielding the interest expense. So when we take interest income minus interest expense, it's more of like now considering asset liability dynamics. So when we plot the net interest income over time, it tells us about the asset liability dynamics over time as to how the bank is stabilizing its management of assets relative to liability. In other words, it tells us how the bank is managing the income it generates or the revenue it generates from each asset and how much it pays on its liabilities. Interest-bearing liabilities like deposits and borrowings. Right. Now, usually we don't want to be looking at things in absolute terms. Otherwise, net interest income is okay to look at. But we want to look at things in relative terms, in percentages. So we express the net interest income as percentage of the total assets of the business. The total, let me take my word, but not total assets as you see it on the balance sheet, but the earning assets, which is the loans plus investment securities. When you do that, you get what we call the net interest margin. Now, a higher net interest margin here implies that, or is likely to imply that, the bank is sourcing funds from a cheaper source. What it means is that even if interest income is stable, there's competition on the market for loans. The loans are not quite doing well in terms of maybe NPL is rising, but of course, we're still able to manage the interest income. If you see the interest income rising, but then we see the interest expense not quite rising to manage the interest income, then you start to see the net interest income rising. It tells us that a bank is actually able to manage net asset liability position quite well. And also the stability in that. When we get into GCB's financials or figures, you tend to see how stable GCB's net interest income margin is. Extremely stable over time. Which suggests that something good is happening there, right? And so a stable net interest margin also implies that there's going to be a stable earnings or sustainable earnings. So there will not be that significant variability in earnings, but it's not a direct relationship because the net interest income is just one input into the P&Ls or into the earnings. There are other things that affect earnings, like the non-funded incomes, fee and commission income, which are like fees and commission income and net trade income, and also items like the expenses incurred by the bank, personnel expenses and all that. And not forgetting our big boy, impairments, which can change the dynamics entirely. But the banks or the analysts want to look at that. So when you do valuation, you want to spend some time looking at that. ROE is also a key thing. Now, the net interest margin is helping us to look at things at asset liability management level. The ROE is helping us to evaluate things better when we look at it in terms of the bottom line, considering all forms of expenses and other forms of income. Now, so ROE is return on equity. So a high ROE links to higher or leads to higher price to book ratio, all other things being equal. And we know the price to book ratio is the most preferred relative valuation metric. So ROE has a direct link to that, direct relationship. A higher ROE is likely to trigger a higher price to book. And if that happens, a higher valuation, think about it. So stability in the ROE over time is important. And especially when we start using valuation models like residual income model, you realize that a stable ROE is very important. Now, the second thing that analysts look at is a risk radar. And now, with a risk radar, well, here, the key thing that is considered is a non-performing loans. Now, so non-performing loans are key things to look at. A high margin, I wanted to say ratios. I think I made a mistake here. I'll have to get back to it. When I'm sharing the notes with you, I don't know why, when I copy this, I have not really edited that. One of those items there. The capital adequacy ratio, what I wanted to say that the non-performing loans, the high non-performing loans will actually affect the performance of the business. Because the whole thing is this: some of the non-performing loans, you can accrue interest on them. Because you can accrue interest on them, the net interest income is going to drop. As that drop, think about what is going to happen to you. It's going to affect the bottom line, which is the ROE, which is a fundamental driver of the valuation. The capital adequacy ratio is also key. Well, now I know because of the DDP, the Bank of Ghana revises to 10%, but it's going to go back again to the 13% minimum and a threshold. And if you are getting something below 10%, at least for now, a lot of the banks that even collapsed were having their capital adequacy ratio less than 10%, of course. So about 9 banks actually failed, as a result. So one thing we are going to be doing, you'll see later, is that when we use the discounted cash flow models, and we want to model the bank's value, we want to do valuation based on discounted cash flow model, we're going to be adding some buffer to capital adequacy ratio. So instead, we may say that, well, we don't want to accept a bank whose capital adequacy ratio, or if you want to value this bank, we ensure that there's enough capital put aside so that it can compensate for potential revisions to the regulation. And there is a way we'll do it. We can do it directly through the statutory reserve. We increase the statutory reserve requirement when we are doing the modeling of the cash flow. And some of these things may be some way to you, but we're going to go through them. And so we actually creating some buffer, okay, in the DCF model for risk management purpose. Good. Especially if this is a bank that is not strong. The bank is not in a good position. Those are the banks we're going to do that for. Let me see if there's any question. And so we move to the last session for today. The final section, I want to introduce you to banking regulations. But I'm not doing the things the way you may be thinking, where I'm going to list a whole lot of regulations here and go through. No, everything I'm doing here is having some connection to how we're going to be valuing a business, like the fundamental drivers of the bank's value, right? Now, so Bank of Ghana's role, there are 3 roles that are listed there. One is stability mandate, the Bank of Ghana. Second one is monetary policy. And the third one is the licensing power. And all these 3 affect how we see value. they affect the drivers of value. Now, so it tells you that the regulator's action could affect how a bank should be valued, or even the final value that will be arriving at. If you talk about the stability mandate here, like they monitor the bank's liquidity coverage ratio, right? In fact, if liquidity coverage ratio, we'll be getting into the details of this ratio. The reason why I don't want to spend so much time talking about them is that we're going to spend time getting into the details of all this. If the liquidity coverage ratio is greater or equal to 100%, it means the liquid asset fully covered the liabilities, right? Then this prevents a bank run. A run on the bank means that people come for their money and it can't find money, right? A lot of people start coming for money at the same time, and that results in people not finding money, right? So panic withdrawals, think about that. That's what we call a bank run. So this prevents a bank run because you have very liquid asset that you can liquidate and quickly use to offset or to meet withdrawals, customer withdrawal demands. Now, monetary policy side. But before I even move to monetary policy, so if you're thinking about bank and the bank's poor liquidity position, it affects how you place value on the bank, because it affects the risk associated with the bank. When you are looking at the bank, comparing two banks, one bank with a very good liquidity position, another one with a poor liquidity position, we tend to place a higher valuation on the bank with a very good liquidity position. All of that is being equal, right? When we talk about the monetary policy side, does it affect? Yes, it does. You see, the monetary policy committee, they come out with the monetary policy rates, and there could be a rate hike. Now, the monetary policy rate basically is trying to tell us the rates that the banks will borrow from the central bank. Now, so that gets that becomes maybe a reference point for the setting of certain interest rates in the country as well. So if we have the monetary policy rate then revised, what it means is that is a new rate that the banks can borrow. If the banks are able to borrow from central bank at that rate, then they are likely to give it to you at a rate higher than that. It used to be called prime rate. Then we also, at the point, we started calling it bank rate, and now we call it the monetary policy rate, right? Now, so a higher monetary policy rate, it creates a mixed feeling. And we're going to look at this into detail tomorrow when we talk about economics of banking. You will see that high MPR or monetary policy rate will immediately or in the short term will result in a bank getting more revenue, because loans that are variable loans, like floating rate loans, those loans that are quoted as GRR plus something or treasury bill rate plus something, if the fundamental or the benchmark rate, which is the GRR, changes, then it means that the bank is going to make more money if it is increasing. Now, the MPR tends to be one of the variables in the determination of, let's say, the GRR, the Ghana reference rate. So when the MPR increases, all of that things being equal, the Ghana reference rate will increase. So if you borrow money from a bank and you borrow that, let's say, GRR plus 2%, then your GRR will rise. That's the meaning of this. All of that is being equal. I'm saying all of that is being equal because there are other components of the GRR or in the GRR model that may not change, or that may even improve favorably. That may even improve, sorry. So we are actually going to look at that tomorrow when we talk about, we will look at the GRR model when we talk about economics, and then you see all that there. Now, so we see interest income rising because people now pay more in interest income, right? But the issue here is that in the medium term, there may be default. If the economy is terrible, interest rate is rising. Do you think people will be able to honor their commitment to the banks? They'll pay their interest to the bank. They'll repay their principals to the bank. That may not happen. Now, so the NIM, which is the net interest margin, NIM, net interest margin, is likely to expand in the short term, but the non-performing loans may spike in the medium term. So we need to compare that. And when we're looking at valuation, we're looking at it in the long term. Therefore, you rather think that the MPR may have a damaging impact on the bank rather than a higher MPR, I mean the hike. may have a damaging impact on the bank than a positive one. The licensing power here. And you may be wondering how this also affects valuation. But guys, let's think about it this way. The Bank of Ghana currently setting 400 million capital floor. Now, we have 33 banks. Then the cleanup led them to 23 banks now we have. You know, this 400 million could be revised. If I know or I have the sense that there's going to be a revision to this capital, should I consider it when I'm doing valuation for the bank? Yes, I need to start considering it. We need to start talking about it. The analysts need to start talking about it on the market. And that's very important. So that will affect. I need to make provision for the potential revision to the capital. So that is important. So you see how I'm talking about this or how I'm discussing this with you. It's not like Bank of Ghana's rule just coming to list the kind of rules the Bank of Ghana. Right? But I want to see the influences of Bank of Ghana, whether it has any impact on how we estimate value. Good. Maybe this is going to be my last slide to go to, I believe, yeah. So here, what I want to talk about is recent regulatory changes. And I talk about the CRR, which is the cash reserve ratio. And I spoke about what the cash reserve ratio is. And there's a revision. You know, previously, there was just a flat rate that banks should keep 15% of their deposit with Bank of Ghana. You know, Bank of Ghana is a banker for the banks, or is the bank's bank. Now, so every deposit the banks mobilize by regulation, you are supposed to keep a percentage with Bank of Ghana. And that percentage will be kept with Bank of Ghana. Whatever you use the money for is not your concern, but the money is for you. However, they are keeping it there just in case of any emergency. In terms of a run on the bank, they know what to do. They are keeping a 15%. And then you can lend out the rest of 85%. I mean, what is happening previously, right? So irrespective of anything, it's just a flat 15%. And that's all you have. And think about the impact on a bank. If I raise 100 million and I have to keep 15 million with Bank of Ghana, I'll still have to pay interest on 100 million to customers, those who deposited the money. I have to pay interest on 100 million. Meanwhile, only 85 million is made available to me to do business. So the 15 million is still held with the Bank of Ghana. And Bank of Ghana pays no interest on that. No interest at all on that. Now, so Bank of Ghana says this, look, I know this is all we've been doing, but I see the banks over time became lazy. And it's a systemic laziness. The systemic laziness here means that everybody wants to invest where it's safer. If I can get 18% from the government, why giving it to somebody for 20% and the person will default? So let me rather give it to government. So they go and buy government securities. And a lot of other reasons, government policies that they want to promote growth in the private sector. They want to avoid or reduce the risk of overcrowding. Overcrowding in this situation is where the banks are chasing a lot of government securities. So they are lending money to the government and they fail to lend to the private sector or the real sector. So what rather have to happen is that we are going to penalize you this way. The reason why you are buying the government securities is that you have a lot of money. So we'll find a way to reduce the amount of money you have so that you don't have enough money to be given out to the private sector to buy the government securities. But when we do that, we want to do it such a way that we are again encouraging you to lend out. So there are two things we want to do. We want to reduce your appetite for government securities and increase your appetite for private sector lending. So what we do here is this. We will tell you that instead of you saying that, bring 15% flat of your deposit to us, it will rather be this way. You are going to bring a percentage of your deposit to us based on the loan to deposit ratio you have. If your loan to deposit ratio is less than 40%, you are going to be bringing 25% to us. Think about it. You raising 100 million from customers, you give 25% to the central bank, and central bank pays no interest on it, and you have only 75% to use to do business. Central bank is doing that so that you are encouraged to loan or to lend to the private sector. Now, as you lend more to the private sector, what happens? Your loan to deposit increases. When your loan to deposit increases, you may move out of this bracket and you may move to the second bracket, which is between 40% and 55%. If you fall in this bracket, you can only give 20% to the central bank. Okay, so when the books are balanced, the regulatory Wednesday, yeah, where they will have to evaluate, assess whether you have whether you have 15% of your deposit with the Bank of Ghana. Otherwise, you need to borrow from the money, the overnight market to offset that liquidity gap. Now, so you will give only 20% to the central bank. Now, if you do better, and let's say now your loan to deposit ratio is more than 55%, then you're going to give only 15%. You see what's happening. They want to encourage private sector lending. That's the key thing. That's what they want to do. That's the motivation behind that. Now, but why is this important? Why am I talking about all this regulation? Think about it. If I'm modeling a bank and a bank loan to deposit ratio is lower than 40%, I know that, look, if so and so percent of deposits, if they are projecting that they are going to raise 100 billion deposits or 100 billion deposits, don't think the entire 100 billion deposits will be used to create loans or investment securities. No. You see the issue here. Now, if I'm modeling the bank and a bank is projecting loan to deposit ratios to be within or between 40% and 55%, then I must factor in a cash reserve ratio of 20%. I can't think that all the deposits they are raising will flow into loans to investment securities just like that. No. 20% will have to be kept and 55% going. Now, so that's how it's going to work. So when the policy becomes effective, Bank of Ghana actually expected to see approximately $16.2 billion to $1.2 billion flow from banks to the Bank of Ghana. And that would mop up liquidity from the market. It serves a number of purposes as well, including some monetary policy objective, like fighting against inflation, right? We want to fight inflation, we want to reduce liquidity on the market to fight inflation. Great. So guys, that is it for today. Before we go, I have a question here. 15% is too high. Oh yeah, even it's too high. That's true, but but let me tell you, if you look at the sector loan to deposit, let me show you the sector loan to deposit and see where the sector is. The sector itself, we saw this earlier. The sector loan to deposit. Sector loan to deposit in 2023 is 30%. Even that is 30% for the entire sector. From 47% down to 30%. Meaning over the last 5 years, the sector had not even gotten into the 55% bucket for it to be thinking about 15%. The sector itself in 2019, if we to date the regulation back, was supposed to be maybe incurring 20%. But now the sector is at 30% 2023. 2024, I'm here to assess that to see whether the sector is doing something better. But it's still below 40%. And we know that if you are below 40%, meaning the requirement is 25%. We expect a change in the sector. I expect 2024 numbers to be better in this regard. Great. I have a great time, right? I think I had a great time. And I want to see if there's any other question to be answered. Do we have any other question? And please, before you leave, don't leave yet. Before you leave, I would like you to tell me something, what you've learned today, whether you've learned something great, and whether you've enjoyed the lecture. And because it's going to be interesting in the coming days. We are just looking at some theoretical stuff, right? Setting the stage for something big. So take some time and write something, right? I want to see you writing something. Everyone, about your impression. I believe the lecture slides will be shared with you later for you all to have. So I just want to hear from you what you think what you've learned, and maybe some things, maybe you are being challenged in some way in terms of the things I'm saying, and maybe what you knew. And what I'm saying now. Well, a lot of messages coming through. Thanks, fantastic presentation. Yes, one question in the Q&A. Let me check. One question in the Q&A. Oh, I need to. Okay, I'm checking it again. Thanks so much. Very insightful. Thank you so much for the session. I found it really useful, very insightful. Kudos to Julius. Very insightful. Thank you. Thank you, Julius. This is very insightful. Thank you. Thanks a lot. And thanks you for the lecture. Great session. I was very impressed about the last content from economist perspective. As you have already positioned the new reserve, I think I'm not getting. Posited, yeah, the new reserve ratio regulation is to combat inflation, ensure stability. Well done, Judah. Thank you. Very practical approach. And thank you, Julius. Very insightful and timely. Well, thank you. Very insightful. I enjoy it. Thank you, Julius. Very good. Thank you. I love this session. The insight on the banking sector performance and guys worth looking into. Thanks. I've acquired a deeper understanding. Thank you, Julius. Great. Thank you so much. Good. Thank you. Here's the question. So, what will you say is the impact of MPR on loan growth in the short term, medium, and long term? Of course, I think I answered that question, right? That in the short term, of course, the floating rate loans are automatically repriced, right? So interest income tend to be higher. Those on fixed loans don't tend to see the impact. But over time they also get priced. The banks tend to adjust their fees rate for new loans, but then it makes loans quite expensive for existing customers. And in the medium term, what happens? People start defaulting, right? We'll look at some graphs tomorrow when we talk about economics, right? Tomorrow we do a lot of economics for the banking sector. So this is my first time in modern. Thank you. I have zero knowledge in finance. I'm planning to apply for MBA finance. I hope this will boost my morale. Oh yeah. Of course, you're going to learn a lot that you'll be impressed. You'll really get. And then maybe you think about the CFE program as well. Very knowledgeable. I really appreciate the analysis of the banking sector. Thank you, Julius. Time well spent. I got more clarity on the key drivers of revenue for banks, interest and commission income. Also from the regulatory perspective, I got a better understanding of MPR as a benchmark rate and the importance of sufficient capital liquidity level of bank. Wow. This has changed a lot about how I view banks now. Great. That's what I wanted to say. It should change your perspective as to how you view banks. The 2024 update and directives are quite insightful. The review of the top 10 banks' financial statement provided some needed information. Yeah, please, will the recording be available? Yeah, it's available on YouTube. CFA Society Ghana YouTube channel. Please, you also do me the kindness to like the YouTube page, CFA Society YouTube page. YouTube channel. And then there are more that will come. So please do that. Thank you very, very much. So over to you, please. We are coming to close. So over to you, Ifri. Hi, Ifri. Trying to get Ifri.
Hi, Julius. Yes, I am here. I do not have any other announcements. The only thing is that I've shared the link for the live session on YouTube, so you can follow that and you would have the recording. We would share the slides and then all other documents that Julius would share via mail. So if you join the session with a link or on YouTube, then you can kindly register so that we can have your email and then share the resources with you. So thank you and enjoy the rest of your evening.
Thank you.